McDonald's is one of the most recognizable brands in the world, but its appeal doesn't stop at restaurants and burgers. For decades, it has also been one of the most widely held stocks in the market. What makes McDonald's interesting to investors isn't explosive growth or hype. It's consistency. Over the last 5 years, McDonald's stock has risen by roughly 40% based on share price alone. That means a $1,000 investment made 5 years ago would be worth around $1,400 today, without factoring in dividends at all. It's not dramatic growth, but it is steady, resilient, and reliable, even through inflation, interest rate hikes, and economic uncertainty. That kind of performance reflects how the business itself is structured. McDonald's generates predictable cash flow because its core operations are tightly controlled. Franchise owners pay rent, royalties, and fees regardless of short-term changes in food trends or consumer behavior. This creates a stable income stream that is far less volatile than most restaurant businesses. For investors, predictable cash flow matters more than excitement. It allows a company to survive downturns, fund operations internally, and consistently return money to shareholders. McDonald's has done exactly that for decades through dividends. Today, McDonald's pays an annual dividend of a little over $7 per share. That dividend has increased steadily over time, which is one of the main reasons long-term investors continue to hold the stock. These payments aren't designed to generate instant wealth, but they quietly compound in the background. This brings up an important question many people ask when looking at dividend-paying stocks. How much McDonald's stock would you actually need to own to generate meaningful income? To earn $1,000 per month from McDonald's dividends, you would need roughly $12,000 per year in dividend payments. Based on the current annual dividend, that works out to owning around 1,600 shares of McDonald's stock. At today's share price, that represents an investment of just under $500,000. That number often surprises people, but it highlights an important truth about dividend investing. Reliable income takes time, capital, and patience. McDonald's stock isn't designed to create overnight wealth. It's designed to reward long-term ownership. What makes McDonald's particularly attractive is how those dividends are supported. The company doesn't rely on perfect economic conditions to keep paying shareholders. During strong economies, it benefits from scale and efficiency. During weaker periods, it benefits from affordability, familiarity, and customer loyalty. That balance helps keep returns stable across cycles. Another reason investors trust McDonald's stock is longevity. This is a company that has survived recessions, market crashes, and major shifts in consumer behavior without losing relevance. Its ability to adapt menus, pricing, and operations while keeping its core model intact has allowed it to remain resilient across generations. McDonald's stock isn't about timing the market or chasing momentum. It's about owning a business that behaves predictably, generates consistent cash flow, and compounds quietly over time. The real lesson behind McDonald's stock performance isn't about fast food or finance. It's about structure. Businesses that control assets, systems, and cash flow tend to reward investors over the long term. McDonald's is a clear example of that principle in action. It doesn't promise excitement, it delivers consistency. And that is exactly why investors continue to hold McDonald's stock.